to you about the follow-up lesson on the accounting equation. And I have attached a paper to your mom and your dad that says what are all the asset accounts, what are all the owner's equity accounts, and what are all the liability accounts. And make sure that you study those. It's very important that you study it so that when I refer to assets, owner's equity, and liabilities, that you know what I'm talking about. And today I'm going to just quickly go through that list with you. You can remember from term 1, we spoke about assets. Now we have non-current assets and we have current assets. Now, as you can remember, current assets is short-term assets. Non-current assets are your long-term assets. Now, an example, if you look at the paper that I've attached, the PDF document, you will see that your non-current assets or your long-term assets, land and buildings, vehicles, equipment. Those are the 3 long-term assets. Okay, now, if you can remember, I'm going to show you on top, we have a debit side and we have a credit side in account. The left side in your T account is debit and the right side is credit. Now, assets are always debit plus, credit minus. So I want you to please remember that your asset is debit plus, credit minus. And that is important for your accounting equation so that you understand whether your asset increases on the debit side and decreases on the credit side. Okay, then we have our current assets, which is our short-term assets. And that is like money flowing into your business and money flowing out of your business. Trading stock, bank, cash flow, petty cash. Those are your current assets. You need to go and study that. Okay, and again, it's an asset, so it's debit plus, credit minus. It increases on the debit side and it decreases on the credit side. Okay, then we have our liabilities. Now, a liability is money that you owe people, the bank, or other businesses. So you are liable to pay it back. If you don't pay it back, you can get in a lot of trouble. Depending on the form of ownership, they can either come and take your assets, of your personal assets, or only the assets of your business. But we will talk about this in the future in EMS. It's not important for now. Okay, so your liabilities that you need to know in grade 8 is your bank overdraft, okay, and a loan that you get from a bank. Now, can you remember I explained to you in class what an overdraft is? You can just ask your parents to explain it to you again if you can't remember. And then a loan is money that you borrow from the bank and you need to pay it back. Now, your liabilities is different from your assets. Okay, so on the debit side, your liabilities decreases. So it's debit minus, credit plus. So your liabilities decreases on the debit side. So when you pay your liabilities back, your liabilities is debited. So it decreases. But when you go to the bank and you get a loan, your liability increases. So then liabilities is credited. Okay, on the right-hand side, credited. Okay, then we have owner's equity. Now, owner's equity accounts are mainly all your income and your expenses. But there are 2 owner's equity accounts, which is listed in the balance sheet account section. Look at that document that I've attached. And that is capital and drawings. Okay, so they are owner's equity accounts. Debit minus, credit plus. So your owner's equity accounts, your income and your expenses, all your income and expenses, as well as capital and drawings accounts. They decrease on the debit side and they increase on the credit side. So they decrease on the left side and they increase on the right side, if you want to understand what I'm meaning. Okay, so owner's equity accounts with capital and drawings. Let me quickly explain that to you. Capital is the money that the owner puts into his account. Can you remember in class I said that, let's say you want to start your own business and your grandmother gave you 10,000 Rand. Okay, now you use that money to start a business. So you put it into the business account. That is capital. It's the money the owner gives to the business. So in transactions, you will see that they will say Refillware increased her capital contribution from 10,000 Rand to 15,000 Rand. That means she had 10,000 Rand and now she increased it to 15,000 Rand. So she gave 5,000 Rand extra out of her own pocket. She's the owner. Refillware is the owner. So if you want to record that in your transactions or in your journals, it will be recorded as capital contribution. Capital. Because Refillware is the owner and she gives capital to the business. She increases her capital contribution. Okay, so that's capital. If Refillware wants to buy her grandmother a gift for her birthday, and she wants to buy her grandmother a nice string of pearls. Let's say the pearls is 3,000 Rand. And she takes 3,000 Rand out of the business account. Then we call that drawings. Okay, so it affects the owner's equity directly. Okay, so that is capital and drawings. Then we have other owner's equity accounts. Okay, now the other owner's equity accounts is listed in your nominal account section. Remember, there's two sections: balance sheet account section and nominal sheet account section. Your balance sheet account section has all your assets and your liabilities, and then those two owner's equity accounts, capital and drawings. Go and look at that PDF that I've sent on the WhatsApp group. Okay, then your nominal account section has all your income and your expenses that's listed there, and they are owner's equity accounts. Okay, so there's capital and drawings, which is in the balance sheet account section. They are owner's equity accounts. It's when the owner takes money and when the owner gives money to the business. Okay, then in the nominal account section, we have the rest of our owner's equity accounts, which is all our income and our expenses. Now, I haven't listed all the expenses on the PDF form. Okay, we'll get there. But your expenses, your income is, at this stage, we are dealing with a service business, which provides a service. So it's current income. That is your income. Okay, then other incomes you have, which is also owner's equity accounts, like rent income. Let's say you've got a building and you want to rent it out to get extra money. That's rent income. Then we also have expenses, which is, for instance, water and electricity that you need to pay for doing your business. It's all the money you need to spend to run your business, like water and electricity, telephone account, fuel, stationery, consumables like toilet paper, the soaps you use in your business, in the bathrooms and to clean, etc. Coffee, tea, those are consumables. Then we have rent expense. Let's say we are borrowing an office space or renting it. We pay to stay there. That's rent expense. So that's also an owner's equity account, which is an expense. We have let me think about the others. I can't so I've mentioned stationery, fuel, consumables, your rent expense, etc. Okay, so those are all your expenditures. Okay, now, so I'm just going to say again, before you go and study this PDF form, remember that in accounting cycle, we said the first step is that we get a transaction. Then the second step is that you ask yourself, what is the source document? Is it check counterfoil? Is it check? Is it receipt? What is the source document? And then thirdly, you're going to go either to the cash receipt journal or the cash payment journal. The cash receipt journal is for all the money we received. So it's when we receive a check, we go to the cash receipt journal, when somebody pays us. When we pay for something, we go to the cash payment journal. Okay, and that is when we issue a check or we receive a receipt. That means we pay. So that's cash payment journal. And in the cash receipt journal and the cash payment journal, after we've completed that, we have to go to the general ledger. We have to book it over to the general ledger. And in the general ledger, you have your balance sheet account section and your nominal sheet account section. That's why I want you to study this PDF form so that you know which accounts goes on the under the balance sheet section, which accounts goes under the nominal account section. So you need to go and study that. And then the second thing you need to study is if that account is under the balance sheet account section, like capital drawings, land and building, vehicles, equipment, etc. When will that account be debited and when will that account be credited? And how would you know that? You need to go and study. All your assets is debit plus, credit minus. Now you might ask me, ma'am, but what is the debit side and what is the credit side? Okay, if you have the T account in front of you, your left-hand side is your debit side, your right-hand side is your credit side. Okay, so assets is debit plus, credit minus. It means, let's say I buy land and buildings, which is an asset. Then land and buildings will increase. I have more land and buildings. So then my land and buildings account, which is an asset, is debited plus. It increases, okay? When I buy a vehicle, my vehicles is an asset, so it's debit plus, credit minus. So then my vehicles increases on my debit side. Okay, so I hope you understand. If you don't understand this in full, don't worry about it. We will do it again in class when I see you, and then I will be able to explain it to you personally. But the most important thing that you need to do now is study that PDF form that I've attached on the WhatsApp group, where all your balance sheet account accounts are listed, your nominal sheet account section accounts are listed. Study where the X tells you whether it's debited or credited. Study that off by heart. Okay, and then after that, I will do an activity with you that you can try, and then I will send you a video again where I explain it. I hope you have a lovely day and remain healthy. Okay, peace to you. Bye.